Good afternoon, my people. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to episode 155, where today we're going to discuss fractional stock share ownership. But before we get into any of that, I got to practice the attitude of gratitude and say thank you, thank you, thank you for each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook page and the Wealth Our Way Network YouTube page. Please, please, please subscribe to the Wealth Our Way Network YouTube page. I also want to give my Wow Nation salute to all the members of Wealth Our Way Nation who watch this program pre-recorded overnight, over the weekends, on their lunch break, anywhere they can squeeze 15 minutes of financial literacy in. And then last but not least, a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. It's been a great week. Back in the saddle, did some great broadcast last night with my boy Kamari Ellis. Shout out to the Finance Rebel. The man is amazing. He was on our program, the Financial Power Hour, from 6 to 7 p.m. Eastern last night. And then I jumped on his program and we went an hour and a half plus from 8 to 9:30. If you get an opportunity, please go over to the Finance Rebel on YouTube and check out Kamari's program. It is amazing. He is a very, very knowledgeable brother. So I talked on Tuesday about the recession. I talked on Tuesday about the Amazon stock split. Basically, what I want to convey, because having some great conversations with Kamari, and one of the reasons I respect Kamari so much is he understands and just is an expert in the things that he discusses. There are so many people out here talking, and they've had about 30 seconds of indoctrination to finances, and now they've run out and become a financial expert. Kamari has decades in the game. We know some of the same people. We've worked with the same people. And when he has an opinion, whether it's completely aligned with mine or not, I respect it because I know he's always going to give me the knowledge and the breakdown of why he feels a certain way. And it came out while we were talking this week. You guys know I am not a big individual security purchaser, but Kamari is. And we were talking about our differences as such. And what the underlying theme was, which I just so embrace, is that we both understand and know that finances are personal. You don't give blanket advice on finances. And that's one of the hard things about being a social media financial pundit. Giving blanket advice to people is impossible to do good accurately because you don't know situation A from situation B. And as a result, what works for person A may not work for person B. When you think about individual stock ownership versus buying index funds or exchange traded funds, my premise is that I am trying to get my clients to buy assets that will grow over time and will have the least amount of risk in those products. My problem with individual stocks are they go in and out of favor all the time. Now, over a long period of time, and this is where Kamari and I share common ground, I believe 35 years from now, if we look at the performance of the S&P 500 versus the performance of an individual stock, like let's say Amazon, their performances are going to be eerily similar. One of them may do 10% a year annualized over that 35-year period. The other may do 11% over that same period. They're going to be very, very close. The difference is the individual stock will definitely have bigger dips and bigger gains over time than the broad-based S&P index. And because we are human, because we tend to succumb to our fears and react based on our emotions, I am always coaching people to put themselves in a position where they don't have to execute willpower. You know, we talk about that with my weight journey. The people who seem to have the best willpower aren't necessarily gifted in the area of willpower. What they have is the discernment to not put themselves in situations where they have to rely on their willpower. Alcoholics who stay off the drinks, they're not sitting in a bar all day. Gambling addicts, they're not sitting in a casino all day. People trying to lose weight aren't at the buffet all day. And people who have problems managing their finances aren't putting themselves in situations where they're watching the financial news or they're shopping. They're making sure that their situation fits their life so that they don't have to execute high levels of willpower. They put a system in place and they can set it and forget it. And that's what we do here at 15 Minutes of Finance and Wealth Our Way. We're a financial planning firm. We do a lot of work in the beginning to make sure that we understand your risk tolerance, you understand your time horizon, we understand your investor profile. We create an asset allocation based on those particular inputs. And then we build a portfolio that will last the test of time. And we average, dollar cost average money into that portfolio based on your budget. Because the other big problem with investing is a lot of people will jump in. Kamari used an example last night of a woman who went into her 401k and took $15,000 out to purchase a program. If you overinvest, you've done yourself just as bad a disservice of if you're not investing at all. Don't put yourself in a position where you have to go back to your investment accounts after you've already started putting money into them. When I was speaking with Kamari last night, something came to my mind about looking at your investment account as like the good area and looking at your day-to-day finances, where we have to pay our bills, where we spend things, kind of as the dark side of what we do with our money. So I had some whole Star Wars thing running through my head. Speaking of Star Wars, Mrs. George Lucas, Melody Hobson, and I hate to lead that way because she's Melody Hobson first and foremost. She's not someone's wife first. She's Melody Hobson first. Melody Hobson is part of the group that has put in a bid, I believe it's $6.5 billion to acquire the Denver Broncos. It's her and a couple of members of the Walton family, which of course are the heirs to the Walmart fortune. And I'm just so proud of Melody Hobson, of Ariel Investments, her dad, John Rogers. Just, it's such a monumental thing to have a Black person and a Black woman to put this bid in. I don't think that it's getting enough coverage. I hope it gets more coverage, but I wanted to shout out Melody Hobson, and the Star Wars reference just made me think of her because she's of course married to George Lucas of Star Wars fame. So thinking about putting your money into an investment portfolio and forgetting it's there is what our goal should be. We can't do that though if we're putting too much of our money in. We have to determine the amount that we can, quote unquote, live without today. And that is what budgeting and cash management is all about. So I wanted to throw all that out there, but really what today's message is about is fractional share ownership, because there was so much hoopla around the Amazon stock split that people can now afford Amazon. And what I'm trying to tell you, if you just listen, is that you always could afford Amazon. If you had $100 and wanted to invest $100 in Amazon, you could have did this last month. You didn't have to wait till a stock split happened. So let's go and see if I can do something I'm not normally good at, which is share my screen. And it's funny because when Kamari and I were speaking last night, he made a reference of not giving companies exposure who aren't paying us. And I definitely understand that, but I'm not big time yet. So I don't have Fidelity, Schwab, or Vanguard, or the other companies that I discussed paying me yet to mention their names. And maybe that happens one day, maybe it doesn't. What I'm not going to do is keep information from you guys who truly need it because I'm not getting a couple dollars on the side. I want to talk to you today about Fidelity's fractional shares stock by the slice program, because it's so simple and so easy. And it is a way for you to open an account and start putting money in that you've budgeted, that you can afford to invest, and buy anything you want, almost anything you want. 95% of the things worth buying, you can buy through this program. A personal note, and I was just texting with her, my baby girl, Sydney, graduated from high school and she got some money from her dad as a gift. And when she was opening up the money, she was all excited, eyes got big. And I immediately told her 50% of this money has to go into a Roth IRA. She has a summer job, so she has earned income. And I told her half the money needs to go into a Roth IRA. We are opening her Roth IRA at Fidelity using the fractional shares program so that she can start building out her portfolio of ETFs and individual securities that she desires to do so. So let's talk about how this works. It's as simple as going to fidelity.com and going into the fractional shares drop down, and you can open an account. But before we open an account, let's just look at what we're doing here. We're buying stocks by the slice, and it gives you a real quick breakdown. Ease. The ease of this is that you can get started with zero commissions, no cost to you to trade, and you can buy stocks and exchange traded funds. There's no minimums. There's no account fees. You can buy for as little as $1 per transaction. You guys have heard me talk about my start in the brokerage industry and how you had to buy 100 shares of a particular company at a time to be invested. And that could be thousands of dollars. You can take $1 and invest in something. If you have $10, you could build a portfolio with 10 different holdings in it. It's crazy. And you have choice. You have access to more than 7,000 US stocks and ETFs for fractional share trading. Now, here's the funny thing. I did not create this page. I don't have billions of dollars to run Fidelity, but I'm not picking on Amazon. But look at what their example is. Their example is Amazon. So how does it work? You have the app on your phone. You go and you put the symbol of the stock or the exchange traded fund that you want to purchase up at the top line. If you don't know what the symbol is, you hit the search magnifying glass and you can start typing in the name of the company and it will give you the symbol. It's that easy. Type in the name of McDonald's, it'll say MCD. It will tell you the last trade that has happened. It'll also tell you the bid and the ask. And for those of you who haven't been following me long enough to understand what the bid and the ask, stocks are offered by a seller and they're purchased by a buyer. And the bid and the ask represent those prices, what someone is willing to sell at and what someone is willing to buy at. You then click on what action you want to take. Do you want to buy or do you want to sell? And then for quantity type, this is the part that you have to, really pay attention to. You're choosing to invest based on the dollars you have, not necessarily what the cost of the stock is. So you're not worried about buying a certain number of shares. You're saying, I have $100 to invest. You put the $100 in there and it tells you right underneath the $100 how much of a share of Amazon you are going to own. It's that simple, my people. You simply go on the Fidelity app, you put the money in, and you say, I want $100 of a particular company, and it tells you you're going to own this fraction of a share. You can build as diversified a portfolio as you would like if you don't subscribe to Big Tank's methodology of using funds through exchange traded funds or index funds. So I don't know how much simpler I can show you it to be. Let me see if I can stop sharing the screen and come back to you guys live. It's that simple. You can go to Fidelity today, open this account, $50 every 2 weeks, $50 every month, $100 every quarter. We come up with a budgeted number and start deploying it into a diversified portfolio and be an investor, start owning things. Or you can just stick to the S&P 500 or other broad-based funds, but it's pretty much that simple. Well, that's my time today. I want to thank each and every one of you who have joined on with me today to listen to 15 Minutes of Finance. I hope you get a chance to check out yesterday's Financial Power Hour. We are off next Wednesday with the Financial Power Hour. We're doing every other Wednesday, but 15 Minutes of Finance will be here next Tuesday and next Thursday. We're going to cover some great topics moving forward. I hope everybody is prepared to have an enjoyable, safe summer. And just remember, wealth is not only for the wealthy. You guys take care and have a great weekend.